Hey everybody, this is Jose Blasco. How are you everyone? It's a pleasure to be meeting today on May 16, 2022 for our SMARTT double T Tiger Live session. My name is Jose Blasco. You can see my email address on the screen as well in case you need to contact me either after maybe you're watching the session recorded, you have questions or anything else. More than happy to be there for you guys. As we are getting to get started, I wanted to confirm that all is good with chat box, live stream, sound, and etc. and everything else. So please go ahead and, if you don't mind, type a quick hello message on the chat box. Apart from nice thing to do to say hello to everyone, that would also tell me that you hear me well and all is good to get started. Also, I'm counting on you to be interactive during the session as always, so we can make this session more useful to you, more special, more fun. And hopefully a better experience, and most importantly, an experience that leads you into being able to build up confidence and trade better, and therefore, you know, seize, if you wish, the materials that we're going to discuss in the form of trades and P&Ls. Okay, so I'd love to get your interaction there on the chat boxes. Know that, by the way, I am watching the chat box on YouTube as well as I am watching the chat box inside the Tiger Broker apps. So I'm watching you all, guys. Okay, so please do not be shy and be ready to work with me during the session. Okay. As we are getting ready to get started as well, and this is the last kind of note before we begin, I wanted to point at the disclaimer on the upper left side of the screen. Please read it carefully. This is always important information when we do a financial presentation. Of course, it's a serious thing. So please read it carefully. It's fairly short. Therefore, I'm counting on you all to read it completely. Okay. Thank you so much. Good. Okay. So what's the plan for today? Well, I'm just gonna introduce myself very briefly. Again, the session really is not about me, it's about the markets and you. But again, I guess that if you are attending the session with me for the first time, maybe you'd be curious to know a little bit of where I'm coming from a trading point of view. So, you know, I'll be happy to share in a moment. And also from there we'll jump into the headlines, then we'll move into the options lessons for the day, and then finally get into our special market commentary, which is the acronym SMARTT, isn't it? It's going to be the very important market analysis that we do, that not only is made out of analyzing the markets and that's it, but is actually made of looking at options data, because options can be used to trade, but options can also be used to understand the markets better, because the data that we find in the derivative markets is extremely relevant, since the largest market players trade derivatives heavily, and that is not seen on the candlesticks or the bars of a chart, and therefore our market analysis, if I can say, it's smart. Okay, so we're gonna be talking about this today. And also, you can see on the screen there is a very nice QR code as well. This is thanks to Tiger Brokers, a QR code that allows you to have no commissions for your options trade on US options. So take a screenshot, take a picture of this QR code, however you'd like to do it, but make sure that you use it. If you have never used it before, well, make sure you grab it. I'll have also a little something for you later in the session. I believe you will appreciate it. So stick around. I'll talk about it later if that's okay. And then Q&A and more at the end. Well, guess what? The Q&A, to be honest, we can certainly leave it for the end, especially depending on the type of questions you may have. But to make it more dynamic, I would like to welcome everybody to ask questions during the session while we're live, because maybe your question is related to what I am actually discussing at the moment, and maybe I can give you a better answer, a more complete understanding of what you need, if you interact with me real time instead of waiting until the end. Okay, and this, I also assume that some of you may be busy and may not be able to make it all the way to the end. So whenever you have a question, go for it. I'll do my best to answer everybody. Okay. Cool. Okay. So my name, Jose Blasco. Who I am a trader. I trade everything, because everything in life got pros and cons. You know, I trade, you know, the futures markets, the stock market, the options market, everything got pros and cons. And therefore I surround myself from multiple assets in order to be properly diversified, take advantage of the benefits, and not to suffer as much the disadvantages that certain assets have, because nothing is perfect in life and trading is the same. Having said that, options is my favorite asset by far. I love it, really, really love it. It gives you we have a website called tradewithufos.com. And if you have never seen it before, probably you're thinking UFOs, what's that? Well, UFO stands for on-field orders. That's what it stands for. And it's absolutely critical because no matter what you trade, the key is the timing. If you buy a good stock, but you buy at the wrong time, good luck. If you sell a good stock, are very critical at this moment in time. It's not like there are 75 pieces of information which are going to dictate what's going to happen with the markets. It's not the case. It's more about the two key headlines that we have on the screen, which are Russia, Ukraine, and the US inflation. Those are the two key elements that I keep repeating session after session, because really that's what matters in the market at this moment in time. Everything else that is happening, of course, may have an impact, but really the swings and the violent moves that we can see, especially in the US markets, going up and going down, they are mostly deriving from lots of decision that has to do with those particular fundamental situations that we have with Russia, Ukraine, and the inflation. So we know in the last Fed meeting, it was said that interest rates were raised again. 0.5 was the number. So, again, all of these generates more definition. What was the following move? Crazy move in one direction, crazy move in the opposite direction the day after. So again, the market doesn't know how to react to these things yet. And, it's wise later when we do our SMARTT analysis, we'll get into the charts and I will point at specifics. There are certain things that we need to wait for to have a clear understanding of what's likely going to happen in the marketplace. At the moment, there is a lot of lack of decision. And therefore, from a trading point of view or investor point of view, it's very tricky to position yourself with too many positions in your account, because given the fact that the market is not clear on what's going to do, you may end up in a very bad position if you position yourself too aggressively at the moment. Okay, so we need to look at our analysis later in the session to define this more precisely. We had many earnings that have been concluding recently. We are almost at the end of the earnings cycle that happens every 3 months. Today, the most relevant earnings are NEO and Wix, which are not that relevant as companies, but those are the most relevant ones. Most of the, let's call it juicy earnings, the Apples of the world, the Metas of the world, etc. All of those reports already took place earlier in the month, and therefore expect a little bit of boringness until the next cycle begins. So again, we will comment more precisely on that. Okay, thank you for those messages, by the way, on the chat box. This is again very appreciated. So the lesson for today: implications around debit and credit option strategies. Which one is for you? Okay, so in other words, we're going to talk about the differences between being an options buyer and being an options seller, being a debit trader, being a credit trader, even though there are many connotations and very specific differences between one and the other, especially when we get in the world of spread trading. Because one thing is that you just buy a call, or you just buy a put, or you just sell a call, or you just sell a put, and that's it. A different story is what if you do, let's say, an iron condor, which uses 4 contracts at a time, 2 calls and 2 puts, which are different. So what happens there? Are you debit trading? Are you credit trading? What are the implications? So there are certain things that need to be understood, because as I mentioned earlier, in life, everything got pros and cons. Same happens with being a debit trader or a credit trader. And those benefits or inconveniences attached to debit or credit trading in options may actually dictate the type of trader that you want to be. You may conclude out of today's lesson that the only thing you want to do is to be a debit trader. You may conclude the only thing you want to do is to be a credit trader. And this has to do with what we're going to cover today. So please listen carefully, because this is important stuff. Okay, and again, questions are welcomed anytime. So do not be a stranger. Okay. So first of all, let's define what is debit versus credit. Well, in order to execute a debit options trade, a certain amount of capital needs to be debited, paid. Okay, so if you buy an option, you are paying, money comes out of your account to pay for that option, so money is debited, and therefore, you could see that, you should see that as a debit options trade. Okay, so debit options trade is when you buy, money is debited, money comes out of your account. In order to execute a credit options trade, it's the opposite. A certain amount of capital is credited to your account. Premium is received. Instead of premium is paid, premium is received. So obviously, it's a totally different scenario. And again, the implications may be quite different compared to what you are envisioning, unless you are an options expert already. But it's important that we talk about it, because at this moment in time, if I was to ask you, so what would you rather do, doing debits or credits? Probably the majority of you would say, well, what would I even pay if I can be credited instead of paying? Let's just sell options. And again, nothing wrong with that, even though there are implications that we need to understand. Okay. So the debit paid, if you do debit trades, or the credit received, if you do credit trades, may or may not represent the risk of the trade. For example, if you buy an option, which is a debit, and you pay 5, then the most you can risk is 5. Let me rephrase that. The most you can lose is 5, meaning your risk is 5. Why? Because you paid 5, so what's the most you can lose is what you paid, is 5. So often the debit, in other words, the premium, is seen as the risk. But that's not the case when selling options. When doing credits, the risk may not be the same, as we will see in a moment through various examples. Also, another confusion that happens all the time, it's the margin required. So for you to take on an options trade, you need to have capital in your account that allows you to do this trade. That margin required is set by title brokers, and typically brokers would follow the instructions or references set by the options exchanges, that they will basically list what is recommended given the current markets of volatility. So what happens? Let's say that to buy an option you need to pay 5, and title brokers need you to have 5 in your account to be able to buy the option. So then your margin is 5. And the risk is 5. Why? Because when you pay 5, the most you can lose is 5. And if 5 is what the broker requires you to take the trade, so then your margin required is 5, your risk is 5, and the premium paid is 5. Everything is 5. That's a very simple example. But again, when we dive into credit options examples, then often it's not like that at all. Okay, and that's why I have a few slides coming with example to clarify all the various angles that you need to understand to not to put yourself in trouble, have your capital under control, and most important than your capital, even your risk, even absolutely well measured. So let's go over a very simple example first, which is the example when you buy a call. Okay, the debit example above is looking at us buying the 100 call, and let's say at the moment of the trade, that call is trading at $2.5 per contract, so you pay 2.5. Okay, and by the way, side note here, in the world of options, when you look at an option chain, everything will have kind of like decimal places, such as like 2.5. But remember, in the US markets, which is not the case in all countries, but in the US markets, options contracts, they all represent 100 shares per contract. So in other words, that $2.5, which is the premium paid to buy the 100 call, really refers to $250, which is 2.5 times 100, because each which is what you see on the option chain as 2.5. Okay, so bear with me on that. So what you may want to be thinking in the back of your mind is of $250. You may want to think about it like that, even though options traders will always talk with those decimal places. So that stock being put to you at that price is something that makes you happy. Maybe you are a value investor, for example, and you had identified that based on fundamentals, that's a very good stock that you would love to own, and owning it at 100, it's part of your trading plan, and you're happy to do that. So then, because that makes you happy, that's part of your plan. So not a problem. It's a very good exercise, a very good application of options trading to sell options. But we are talking about the implications, right? So you would indeed have the option, the debit trader versus the credit trader. Okay, now, when we do spreads, that's when many things change. Okay, that's when many things change. So when buying or selling is simple, it means you buy options. You buy a call, you buy a put, one at a time. You sell options one at a time, selling a call or selling a put. It's simple. You sell a call, you sell a put, you are a credit trader. Simple. But we enter a new dimension when we start utilizing option spreads. Okay, option spreads means that we are using multiple contracts that may or may not belong to the same expiration date, that may or may not be different strikes, So we are utilizing multiple options contracts combined all together, where are sold, or all contracts are purchased, or all contracts are sold, and we create some sort of a combination that could be, buy one call, send one call, or could be buy one call, or buy one put and a call, or sell two puts and buy one call, and you name it. All combinations are possible. And if you buy an options book, typically those books got 1,000 pages because of this reason, because there are so many different possibilities for combinations. Okay, you can do so many different things with options, which, by the way, the majority of things that work the best are the simplest one. But the reality is that you can do so many different things with options. Okay, so that's what we call spreads. Okay, so what happens to the debit or the credit in this case? Well, in this case, we don't talk about a debit or a credit. We talk about a net debit or a net credit. Why? Because let's say, if you buy a call and you buy a put together at the same time, right? So then you buy and buy. So then, of course, it's a debit. No need to mention. It's pretty clear. But what if you buy a call and you sell a call? So now you are buying an option and you are selling an option. So are you a debit trader or are you a credit trader? And the answer is it depends of the prices of those options. If the net result of buying an option and selling an option makes you a net buyer, so you are a debit trader. If the result of selling an option and buying an option makes you a net seller, so now you're a credit trader, right? So it all depends on the price points. It depends on the dollar amount you paid or received when you purchase those options, which depend on their expiration date and the strikes. Let me give you an example, because this is a bit abstract unless I give you an example. Take a look. We are looking here at a bull call spread, okay, where we are buying a 5 and we are selling the 120 call at 1.6. Okay, so we are buying the 100 call at 2.5, selling the 120 call at 1.6. The net result would actually be a net debit of 0.9. So that's a debit example, a bull call spread, which is a trade where you buy a call and you sell a call at a higher strike with the same expiration date, that it would produce a debit of 0.9. So if 0.9 is your debit, what's the risk? 0.9. You paid 0.9, so what's the most you can lose? 0.9. So what's the margin required? 0.9. Okay, that's how it works. Okay, that's how it works. In this case, you buy an option and you sell an option. So for one, you are a debit trader. For the other one, you are a credit trader. But because the net result is a payment, is a debit, so then you are called a debit trader, and therefore you have the same consequences, which is risk equals margin. You have the same consequences as if you just bought a call or two options together. What if you did the example below, which is the bull put spread? If you sell the 100 put from before that was trading at 2.5, and then you buy a put lower, let's say the 95 put, that is trading at 60 cents. So you receive 2.5 and you pay 60 cents of premium of $1.9. So you are a net credit trader, because even though you paid for an option and you got paid for the other one, the total amount received was greater than the total amount paid. So your net result is a net credit, not a net debit. So you are a credit trader, even though technically speaking, you are a debit trader of one option, you are a credit trader of the other option. But when you combine the two together, you are a net credit trader. And what happens with the risk and the reward in this case? Well, the whole thing changes now. Okay, and this is what's beautiful. So what's the most that can be lost? 3.1. And you're gonna be like, why? 3.1? How did you end up with a number? Well, 100 put, earlier we concluded that the most you can lose is 100. But what happens now? You are buying the 95 put below. So if the stock was to fall from full 100, you would only lose the difference between 100. You to be exposed to a risk of 5, you are actually being paid 1.9. Okay, you are being paid 1.9. So what is the net risk of the trade? Is 3.1, which is 5 minus 1.9. So the most you can lose, which is the risk, is 3.1, and therefore to do this bull put spread would also require a margin of 3.1. Okay, again, this is the impact when you do spreads on how you now know if you're a debit trader or a credit trader. So trading debit strategies, most that can be made depend on the strategy. Okay, so depending on the strategy you buy, you will have limited. So so if you infinite, even though that's not going to happen, but again, one more time, the most you can make depends on the strategy itself. How do you combine those options contracts to create a debit will dictate what's the maximum profitability of the trade. But what's the most you can lose? Well, the most you can lose, which is your risk and therefore your margin, is what you paid. The net debit, the net payment out of combining those various contracts, which in the prior example was only 2 contracts, but 2 contracts combined. I mean, probably not a good idea. Grab it. Okay, this is a bonus resource. The bonus resource I mentioned before is called AutoClimate. It's an app that runs on TradingView. We will have charge right now, so you'll see me use it, but on your computer screen, on your phone as well, using TradingView. And while there is a cost, right, if you come to our website, there is a cost to get AutoClimate. If you use the coupon code CLAIM8 that you can see there on the screen, so that cost basically is waived and you get it for free thanks to Tiger Brokers. So do that. And as you are doing that, I'm going to stop sharing my screen so I can then, instead of sharing my slides and my face, what I'll do is I'll share the charts. Okay, so bear with me for a moment so I can share the charts and we can go over our market analysis. Okay, just give me 1 sec. Almost there. Okay, cool. I believe that you should be able to see my screen now. And again, it'd be great if you could confirm that in the chat box, but I believe all should be good. So this is, again, I'm pointing at the QR code again one more time. I'd like to flash at the speed of the light our website in case you have not been looking at our website. Please take a look. There are apps, there are courses, there is coaching. We run a calendar of session where almost every day of the week we are trading. This week on Thursday, I will be trading options. And on Friday, Josip, another instructor in our team, will also be teaching options. Okay, we do this on our page. You can also see us on our own YouTube channel, and again, all those sessions will certainly help you to learn very, very much. The apps are here on our website. You have monthly and yearly memberships as well, so you can consider all these functionalities for your own trading. Leave, or should we? Yes, correct. I was concerned that maybe the screen was not sharing properly. Okay. Anyway, so let's get into the charts. Okay, and I'm gonna move here into our platform top. Okay, so we're gonna start with the market analysis. We're gonna be looking at multiple sets of data. We're gonna start with the AutoClimate. Okay, which is the tool I just mentioned before. And you can see that the AutoClimate is currently, this is the S&P ETF SPY in the US markets. You can see the current dot that we have in the AutoClimate is a thick red dot, which means that the climate is confirmed to the downside. Statistics suggest that a normal duration for the climate is 3, where the current duration for this climate has been 6. So in other words, from a duration point of view of traveling to the downside, we have surpassed the 1 standard deviation. We actually just hit the 2 standard deviation, which statistically speaking means that this climate is more likely going to reverse than stay. Even though it doesn't mean, reversing doesn't mean it's going to go to the moon. Reversing means that you may get a little bit of blue just to have another push to the downside, a little bit of blue to get another push to the downside. So in the prior trading day, the market went up quite aggressively. So today, it looks like the market is going up and down a bit, but later in the session, we may have a little bit more of blue. And then probably 1, 2, 3 days later, back to red. Okay, so this is basically what AutoClimate is telling us. Also, in the bottom part, I'm looking at the gray line and the blue line data. Okay, this is not based on what we have on the candle on the charts. This is based on options data. This is looking at the implied volatility of the puts in gray color versus the implied volatility of the calls in blue color. And you can see how the puts are way more expensive than the call at this moment. Is that people are buying more puts than calls, or people are selling more calls than puts. And the only reason to do that is because people have a very strong bearish sentiment in the marketplace at this moment in time, which is the reason for these very intense red climates that keep developing, surpassing the statistical normal duration of 3, Notice that this one lasted more than 3, this one lasted more than 3, this one lasted more than 3. This is telling you that, you know, we are going beyond the normality all the time, which means a lot of push to the downside, a lot of selling pressure. So it's pretty aggressive, okay? Pretty aggressive. The S&P futures is showing us a collection of UFOs. Okay, I mentioned our technology UFO is patented. So we are identifying the unfilled orders in the market. You can see that there are unfilled orders here. Price came to the unfilled orders, price came to the unfilled orders, and price bounced. Price came to where the unfilled orders were, price bounced. So again, we now know that at 40.22 as well as 39.65, we have unfilled orders to buy or sell, buy on green, sell in red. And the market is right now a bit in the middle of nowhere. So we do need to see the market define itself right at the open, see if the market is going to fall a bit or rally a bit. But if it falls and hits the green, it's likely going to bounce back up. If it rallies and hits the red, it's likely going to go back down again. So this is where the high and the low for the depth potentially are, out of knowing the unfilled orders. On the SPY ETF, looking at the same market, but instead of looking at futures, we're looking at the ETF, which only trades 6.5 hours a day instead of 23 hours a day like the futures. When looking at this market, we can see that we have a few more unfilled orders to buy, a bit closer to price. The opening price for 100.32, it closed at 401. So the market seems that in a bit more than an hour, it's going to open just slightly lower than the close yesterday. And that means that the market is very likely going to come in here and from there bounce. If that's the case, careful, because in the futures markets, if you recall, we also have unfilled orders to sell. And again, so today, my expectation would be that it's going to be, you know, a little bit of a boring day, you know, that kind of, you know, a candle like this, market going down, going back up, going somewhere in the middle, and end up something like that. That would be my expectation. And we may even have a change of color tomorrow, going from red to blue. Today, for sure, it's going to be red. But in the next day, maybe we change to blue, and it'll be interesting to see how things define themselves in the following days. Okay, because right now, even if it goes to blue, I'm not too bullish, to be honest. Why? Because the implied volatility for the puts is above the implied volatility for the calls, gray above the blue, and therefore the bearish sentiment out there, it's very powerful. Okay, so we cannot ignore that. I mean, for the ones of you out there long, or the ones of you holding long-term positions and things like that, I wish I could have a different outcome of my analysis, but this is market data. This is what we have at this moment in time. What else? Well, we have one line here which is kind of hidden. Okay, it's the one which is red color. It's right there. It's you know, kind of like embedded, you know, within the blue lines, and that's why we almost don't see it, but it's there. So this is telling you that the implied volatility, to be honest, it's not too expensive. Okay, it's not too expensive. When we get for example, when people get scared, okay, and options become very expensive, what tends to happen, okay, it's something like that. Okay? Something like that. You can see here how the red line, okay, on that particular day when the market was falling pretty hard, on that particular day, you can see how the red line is measuring the historic volatility and the red line measuring the implied volatility. And therefore, options are very expensive at that moment in time, and it would be nice to sell them. But when we go back to the current date, okay, the last candle on the chart, so you can see how there has been a lot of contraction on the implied volatility, and the blue line now is beyond the red line, meaning that, you know, the options are not so expensive anymore. So now they are not cheap, okay, but they are not that expensive anymore, which represent a little bit of calm coming into the marketplace, which again may lead for the market to rally a bit more, and again have a change of climate from red to blue for a few days. So, and then, you know, depending on the options data, we'll then conclude if that blue climate is likely going to continue, or that blue climate is going to come back to red. At this moment in time, this is a pretty decisive week where this red climate is probably going to define itself as, you know, continue going to go blue to go back to red, or go blue to stay blue. Okay, that's really the key. When looking at the volume map, we can see as well plenty of indecision, which is again another component that makes me very bearish at this moment in time. We had this beautiful massive move, like 2% plus on the last trading day, right? But again, not only we have the implied volatility of the puts higher than the calls, which is very bearish. On top of that, from a trading point of view, even though the market went up a lot, in most of the expiration dates, notice the gray color in the values I am underlying. Okay, that one is not, but almost everything else is gray color, meaning that more puts than calls were traded. Okay, 1.1, 1.2, 1.5 times more puts than calls were traded, and they were bought, not sold. How do I know? Because the implied volatility of the puts is greater than the calls. So it's bearish. It's bearish, and I'm very curious to see what's going to happen in today, tomorrow, because we may have a change of condition, and a change of condition would look like not only having a blue dot here, okay, not only having a blue dot here, that would be a change of condition, but on top of that, having this blue line cross over and now be above the gray line that would then be lower. Okay, that would now tell you that not only from a price action point of view, but also from a derivative data point of view, we are now dealing with a much more robust environment where now the market is likely going to continue to go higher, which is not the case at the moment. Open interest is also revealing, options open interest is also revealing 400 as a very important strike with lots of open interest, okay? And guess what? The market is going to open today at 400 plus. Okay, so again, that green UFO we have on the screen that we saw earlier, let me show you again. This green UFO located at 400. It's certainly very relevant because from an unfilled orders point of view, we have unfilled orders in the market waiting to get filled. But from an options point of view, okay, we also have a very, very high open interest at this price point, which is very likely going to act as a support, and therefore a level where additional unfilled orders may be even added to the unfilled orders that already exist. So again, I am not bullish in the sense that I'm not looking at the market going to the moon. I'm not bullish at all at this moment in time in that sense, but I am not bearish in the sense that, the market is going to fall to zero. Not at all. There is, again, the climate is very tired to the downside. The climate is more likely going to switch to blue than continue red based on stats. It's not me saying it, it's computer data, it's market data being processed by the computer. And on top of that, we have very strong open interest and unfilled orders below price. So this should hold it for a while to go back up. And as it changes climate to blue, then it'll be the time to reassess market data with option to see if now we are dealing with a short-term blue climate to go back to red, or the blue climate is now going to stabilize, and then we'll go back to, I'll go back to be bullish like I was a few weeks ago when these type of moves happen. Okay, you probably remember in those sessions, but not very bullish, and that one I was actually wrong. But from there, I did mention to be very, very cautious and look out the whole thing that happened afterwards. So we are in the same situation now, where we may have a little bit of a breather like this, just to go back down, okay? Or it's just gonna be go back to like this, okay? And options data combined with autoclimate basically will reveal that for us. So anyway, this brings me to the end of the session. With the market analysis. Hopefully this is today, I believe it's the session where I got the least amount of interaction from you. Maybe it was a topic that was already understood. So then in a way, I guess it's good. We have been reinforcing something important. But for sure, if the reason why you have not interacted too much, whatever it is that you need, and if the answer is coming later, let me be the one to tell you, or maybe your question is subject for me to build a special lesson for you another day in the future, and I'd certainly be happy to do that as well. Okay, so for future sessions, and make sure that you are with me on that, and also for the ones of you that may be watching this recorded, let me go back to the end of the presentation here. So again, one more time, you have the email, you have the QR code here for you to use your autoclimate for free, all of those things. So do not miss it, and email me if you need me, and I will see you in the next one. And as always, before I say bye, also I want to say thank you so much to Tigers Brokers for organizing these beautiful Tiger Live sessions with all amazing presenters and instructors. And again, a pleasure for me to be one of those that is invited to join you in such a unique community. So thank you so much, Tiger Brokers, and you guys take care, trade well, and I will see you next time. Bye-bye, everybody.